Really happy to be moderating this session where I would personally like to also know a lot about the opportunities in the space that we have here. So as you can see, from venture capital to real estate to alternatives and the like in terms of going to private equity. We have the entire spectrum from an investor's perspective in terms of what to expect. So I hope that the next few minutes I will be able to take our guests through how they see the opportunity space going forward. I just had a look at how much do alternatives actually form part of very large portfolios globally. And if you look at the UK, for example, UK pensions, there is about 30% now in alternatives, which about maybe even 10 years ago would have not been even 2%, where equities and fixed income would largely make up most of the asset classes. If you look at Europe, things are actually a little further behind the UK. So that's about 15% in alternatives. And when you look at alternatives, they are talking about hedge funds, they're talking about mortgages, they're talking about straight lending, they're talking about real estate. So I think if you take the 15% sliver and cut it down, so not a single alternative asset class actually crosses 3%. So as you can see, this is an emerging asset class per se. And what I'd like to actually, for all of us to also understand, is in India, how do these stack up and whether they will become part of large portfolios such as insurance companies, banks, or for that matter, pension companies, as and when they become large in India. For example, I might want to also share with you that HSBC runs the largest EPFO mandate in the country. And the EPFO surprisingly has just allowed for ETF investments 2 years ago. So as you can see, we're at a very nascent stage of getting involved with alternatives ourselves. But those represent fairly large pools of money. We're talking about close to $100 billion in EPFO pool across India. And even a small percentage starts going into alternatives, I think they could mean significant opportunities. So with my short introduction, let me focus on our guests. I'm going to do a random thing, so it's not going to be in line. But I thought picking up on something which is very, very dear to our hearts as long as we are in India is real estate. And the promise of real estate returns have started to come off most people's eyes as we go along. And would really like to know what are the opportunities that an alternative can set up to kind of capture the opportunity. So I'd ask Binit to just take us through the opportunities as he sees it.
So if you look at the landscape, the history of alternatives in real estate is around 12 years old in India. 2005, when the FDI was opened, is when we saw this euphoria of a large number of managers coming up and setting up shop, both domestic and international guys. And of course, that was followed by despondency and disappointment given how the managers performed and how the underwriting was done, largely also because of the, I would say, inexperience as far as the managers were also concerned. Now the industry has, I would say, matured. The number of managers who have performed are around, and a lot of them have died over a period of last, let's say, 6-7 years. And the opportunity landscape is already big. If you look at housing as a market, it is understood that more than 20 million homes is a shortfall today in urban housing itself. So the latent demand for housing is huge. As far as the investment potential is concerned, as far as the domestic investors were concerned, the only mode for them to take exposure to this asset class was through direct investing, which brought its own risks with respect to exposure to a single asset, only hoping on a price rise for you to make returns. Whereas now with alternatives, of course, you can take on that indirect mode of investing, A, to participate in development, and B, diversify your risk, and of course, more professionally managed investing philosophy. So they're largely, if you look at the opportunity today, the largely two brackets I would put it. One is on the housing side. If you look at the focus as far as the government is also concerned, given the kind of employment generation and multiplier effect housing has on the economy, the government is putting a lot of, I would say, effort and money behind that affordable housing theme. And we see a huge potential of this industry expanding as far as the affordable and mid-income housing is concerned. So that is one space where we see a lot of opportunity, wherein there's a, I would say, an opportunity both for institutional capital and insurance companies, and also large family offices to put in money and participate in that. So that is one spectrum. The other spectrum is, of course, on the, I would say, the yielding asset side, wherein until now, this participation has been mostly from large global pension funds who are putting, I would say, huge amount of capital behind some of these office assets over the last 6-7 years in India. With now potentially REITs coming in maybe very soon, we see that opportunity also being available to also the family offices and retail investors. So on the spectrum, on the development side, you have that ability to make higher returns and IRRs or structured returns on the development side. And on the other end, you have this patient long-term capital which can be deployed in steady commercial retail assets. So these are the large two opportunities which we see for alternatives over a period of next
Thanks,
10
Binit.
years.
I think I will definitely come back to you in terms of the expectation of yields, because as you know, asset class prices have gone to a level where yields then, as a consequence, do come down, so the attractiveness. But I'll come to you later because there's so much to cover. And I'd like to now come to Rahul. Trifecta Capital, he's a founder and managing partner. What I'd like for him to share with us is that he's in a very interesting space. He's lending to early stage businesses. Now, we all know that that's a taboo. Typically, we just give them capital. We don't lend money to them. But I'd like him to speak a little bit in his own way. What is this space and how can people get involved in it?
No, thank you. Yeah, it's the first question LPs would ask us, which is, am I taking equity risk and making debt-like returns? And I think once you were able to put some comfort around that answer, we were able to raise a lot of capital from Indian institutions. But just to take a step back, venture debt is a relatively new asset class in India. In many ways, it's a subset of the venture capital industry. It tends to lag venture capital by 10-15 years. Because in many ways, the underwriting philosophy of venture debt funds is to understand how venture capital flows work, how companies go from Series A to Series B, what are the risks at different stages of these companies' life, and how reliable is the counterparty, in many cases the venture equity fund, how much are they going to do to protect their money. So having started my career in venture capital in, say, 2005, saw the evolution of venture capital over the last 10 years. And there was a clear gap where lots of our founders would come to us and say, can you lend us some money? We don't want to dilute. We want to fund a small acquisition. We want to fund some CapEx. We have working capital needs. But you equity investors only want to give us equity. And so I think when that pattern became clear, there was an opportunity to go solve that problem. And so around that, we founded the first venture debt fund in the country. It was hard because there was no data to explain to Indian institutions, so we relied very heavily on the experience of venture debt as an asset class in other markets. And there'd been one NBFC prior to us in India that had been doing venture debt with some success. But it was structured as an NBFC, not as a fund, and they hadn't raised any capital in India. So we went out and really created a framework by which large institutions could assess the risk profile of our business. It helped that we had some very high quality anchor investors, including a bank and a very large endowment, subsequent to which we were able to get in both public and private sector insurance companies. And then along with that, we brought in a few large family offices. So today our fund is about 500 crores. And in many ways, the way we manage our risk is to really focus on the top end of the quality. We don't do bridge funding. We don't do distressed. We really focus on companies that have broken out So companies like a Big Basket or a Paperboat or Urban Ladder, Urban Clap are all in our portfolio. And generally, they represent either the category leader or the challenger. We believe there's probably not room for number 3 in many of these sectors. So if we can't get into number 1 or number 2, we generally will not lend. And so to compensate for some of the risk, we also take a little bit of equity. And the way venture debt deals are structured is you typically have a short to medium term amortizing debt. And along with that, you take a small equity option, and that gives you some of the upside. As an industry, it's relatively small. I think the estimates are that the market can absorb a few thousand crores of venture debt every year. And so besides us, there's a couple of other folks that have now started to offer venture debt. But it's fairly early days.
Okay. And just one follow-up quick question
Yes.
is, what sort of experience do we have of this asset class globally? Is
Yes.
it very large?
So it continues to be more boutique. It represents anywhere between 10 and 20% of the venture capital allocations. So in the US, as an example, it's somewhere between $4 and $6 billion of venture debt deployed every year, compared to, say, 50 billion in venture capital. But it is quite popular with mid-sized and small pension funds. The risk profile is very tuned towards people who are looking for range-bound, predictable returns. And so as an asset class, it's actually done very well in the US, and surprisingly has had very low loss ratios, 2 to 3% over 15, 20 years.
Exciting. Something which I hate to call a more traditional asset class, which is something which has been around for a long time, and it all began with people starting businesses called venture capital. So Vikram Gupta, founder and managing partner of IvyCap, it's an evolving space, and what I'd like for you to just illuminate all of us is, what are the trends that you see today? Venture is always venture and it's always evergreen, but what are the kind of opportunities that you see today, and how is your business shaping up?
So we are currently managing 2 venture capital funds, which we've raised almost entirely in India, almost entirely from domestic institutional investors too. In fact, my prior experience with Ajay Piramal, I had a fund which was focused only on the healthcare life sciences sector, which I had raised from 30 institutional investors in India. These are all banks, insurance companies, primarily. And so of course, having built those relationships over there, I actually went back to them to raise our venture capital fund, and then raised our first fund, which was a small 240 crore size fund, which we actually invested across 10 companies. And then after that we raised a second fund, which is about 600 crores, which is actually coming from most of our first fund investors, who again institutional investors, came back, invested in a second fund, and a few more got added in the second fund as well. In terms of the trends, of course, I've seen this industry from 2007 when I started my first fund with Ajay Piramal. And of course, I see a huge change how this has evolved over the last few years. And I think some of these things are very, very interesting, how I feel very fortunate to be part of this entire evolution. I remember the time when we went for SEBI filing for a Piramal fund. Every fund used to be called venture capital fund, whether you are a private equity fund or whatever size fund, everybody used to be called a venture capital fund. The regulations were changed in 2013 when they called these asset classes into AIF 1, 2, 3. Of course, the entire startup mindset started in 2015 with the government actually really starting this entire Startup India, Stand Up India movement. In fact, at the time when I was running the Ajay Piramal fund, startup was actually a bad word. In fact, even at the time when I started IvyCap, startup was actually a bad word in the sense that you don't know whether you'll get your money back. So that was the mindset. The mindset actually is still evolving, but I would say it's still not there fully yet, because people haven't seen full cycle returns. So whatever exits that have happened, I think that have happened primarily because of some next round funding happening, or angel investors getting exits here and there. But I would say venture capital funds are still not able to really justify why I can give you this kind of returns, because there's no story yet which can actually justify the actual reality on the ground. So I think that's the challenge that you face when you actually go to the LPs and try to convince them that, here's a venture capital fund, please invest in this fund, especially institutional investors who don't even understand, the difference between the venture capital and private equity today. And of course, a lot of investing that they're doing is because of the entire ecosystem, the mindset of the government changing, how the media has been talking about it. And I think the last 3 years, I think media has contributed a lot, right? So all you read in the front pages, and there's a startup and tech section, pages in the newspapers which only talk about startup funding. So I think it's all positive for the country. And I would say that a few good exits and maybe few full cycle returns to the LPs would, possibly change drastically the next wave in this industry. And I think, of course, we are quite optimistic. What we are seeing as a next move, we are actually going with Trifecta's, also experience, and also the LPs, given that I think some of our LPs are same. And they've been asking us, why don't you launch a venture debt fund? Okay. On the other side, we have these, our sponsor is the IIT Alumni Trust. So almost every company which is either run by an IITian or mentored by an IITian actually typically ends up coming to us for some kind of support or funding. And many of them actually say, we're not looking for venture capital, we're looking for venture debt. So it's like we have pressure from both the sides. So we actually said, okay, makes sense, let's put up a structure which is actually, enabling this kind of thing. So we actually launched a venture debt fund, which is, recently launched, and we believe that, we should be hitting the ground in terms of actually investing also very soon with that. So that's...
So blue sky, I would think these things are just evolving in this country, and you're hopeful things will develop. Coming to Prashasta, now he's part of a fairly large financial conglomerate which is very keen to get these kinds of products available for the large masses, because I'm sure that so far we've heard very specialized investors, extremely narrow range in terms of who you can approach for these kind of sophisticated products. But being an IIFL and being in a very critical role as much as possible to kind of broaden the demand for such products, I mean, how would you describe the landscape, and what are the opportunities that you see in India today?
Yeah. So I think if you are thinking in terms of opportunities, if you see globally and see the share of alternatives in the overall portfolio of the client, and let's say you compare that number in India, I think we are talking of a very, very different scale, between what has happened in India and what is happening globally. Our sense is that I think India will, over a period of time, move towards global averages. And if that happens, I think alternatives as an industry or, differentiated products, I think could rise multifold from, where we are in the evolution of, the client portfolio as it's today. So I think what we have seen, I think in the last, few years is clients' attitude changing very, very drastically, on alternatives. I think initially, maybe 2 or 3 years back, there was a lot more reluctance to try alternatives, because I think people had some bit of a bad experience in venture capital funds that were launched in 2007, 2008. People hadn't made money. And to that extent, I think they were slightly hesitant to, try some of the new products that were coming in. But over the last few years, I think what we have seen is that given the fact that, the space has evolved, you have a lot more variety of products to choose from. You can specifically, look at the risk that you want to take. Because of this evolution, I think, and the fact that some of these alternatives have also kind of done reasonably well or are seen to be doing reasonably well, I think there is a lot more openness, in clients' mind to try new products, to see differentiated strategies. I think from our point of view, what we try and do is, at the asset management side, try and identify where the gaps are and try and see if there is something that we can offer there. So for example, under me we have listed equities, pre-IPO, Series A, venture capital. And our endeavor is obviously, because we have, access to, a lot of these asset classes, or we understand or what we see in a lot of these asset classes, is to identify where there is a gap, A, in terms of products, B, in terms of relative value that is there in the markets, and you kind of look and try and, bridge that gap through a product. So for example, I think, a few months back, we saw a big gap in the pre-IPO space. I think we launched a fund and it has been a big success. Similarly, right now, if you ask me, I think private equity growth is, 50 to 75 crores. Deal size is a space where there could be a lot more opportunity than, others in terms of relative capital that is chasing that asset class and the relative opportunity size. So our constant endeavor is to, look at multiple asset classes, see where there is relative opportunities, and give a client exposure to that. I think the good part is the clients are kind of more open to taking those exposures. And if you have the right product, I think there is a big enough market to tap into.
Excellent. I'm going to have another round of questions, but this time maybe a little more specific. And after that, we'll try to open it up for all of these gentlemen to ask you the questions direct. I just want to spend some time on valuation and pricing. So, Binit, coming to you again, if you were to say you go to Singapore where your current yields are absolutely lower, even in the US where if you go to put money in a bank or try to expect any return from a bond, typically you'll be happy if you get 3.5%. But if you try mortgages, if you try yields of real estate pools, then you can hope to get between 7 to 8%. So there is a differential between why people are attracted to REITs, as opposed to in India where your hurdle rate so much is actually so high, as opposed to rental yields because of the valuation, that we actually have an inverse relationship. So how is it that you think REITs will be attractive in a country like India?
So I agree with you that REITs are finely priced if you look at the pricing which is prevalent today. But one factor which we need to take into account in a market like India is the growth. So for example, any office asset which is available today at 8%, you need to factor in a 5% growth which comes in the rental. So 8 plus that 5% gives you that 13% on an overall basis if you were to hold that asset over a period of time. So there's an 8% yield plus a 5% capital appreciation which will come when you dispose of that asset, may say after 3 years or 5 years, because most of the rentals are locked in a manner where the escalations come in at 15% every 3 years. So I think that is one aspect which is unlike US where the rentals will be more steady and long term, locked in for 10 years, not much escalation. And B, the fundamentals of commercial office in India are very strong. If you look at the period between 2007 to 2012, not many projects were launched. So all what was left behind was finished. A little bit of supply is coming in now. So I think that is one aspect which we need to keep in mind when we compare returns. So if you look at 12-13% overall versus a 7.5 GSEC today, REITs are still attractive. Why it took a little bit of time is because SEBI had to sort out a lot of issues with respect to taxation, dividends. The other challenge is stamp duty because that's a state subject. So these 3-4 things where those things will need to be resolved. And I think the fundamentals are in place and REITs will be attractive if you take into that account. B, in addition to office, there are other space or opportunities which institutional investors are looking in today. For example, warehousing, because of GST going away, warehousing is going to be a big opportunity. Retail, large format retail, grade A space, where the consumption demand is going to drive the volumes and therefore the rentals in these retail formats. So that is another space where a lot of large institutions are looking at. So I believe the opportunity is very large. The projections are in the range of at least $15 to $20 billion of real estate which should be available to be REIT in the next 3 years or so. So given all these facts, and I don't think so that it's steeply priced.
Yeah. Excellent.
It's fairly
In fact,
priced.
what I would like to also add is that if you look at how the evolution has been, it's more from a liquidity perspective as well, right? So when you look at a REIT, if you have pools of assets and suddenly you get redemptions, it is typically better to have a secondary market for people to either buy and sell these pools, and that's the way that you can even maximize yield sometimes.
Yeah.
And we hope that we get there at some point. Coming back to pricing, and when we are on yields, really like to know how much you charge your...
Sure. So, in many ways, our portfolio companies don't have access to traditional credit. So we're not necessarily benchmarking to bank rates of lending or even NBFC rates. But what we try and do is we try and keep the cash impact relatively modest, because ours is a cash coupon product and companies have to pay us every month. So what we found is that band of sort of 14.5 to 15.5 seems to work. The equity investor is also comfortable with that number. I think if you get into the 18-20%, it starts to drain money out very quickly. And if you get into the lower band, then you're actually mispricing it completely. So I think our goal is to try and not create too much of a burden on the company. The going rate for the asset class today is that 14 to 15 band. I think there's a little bit of pressure on us as well, even though we don't borrow to lend. I think there's a perception that interest rates have come off since we raised our fund, so therefore we should be able to lend at lower rates. And my answer often to that is, look, well, has the cost of equity come down, right? And if you can raise equity, then please raise some more. But there is pressure, and I think as ticket sizes get bigger, it does get a little bit more competitive. What we have been able to do is, as a percentage of the debt, we typically take the equity kicker as a percentage of the debt amount. So that average for us is anywhere between 12 and 15%. So if we put in 10 crores, we'll take 1.5 crores of equity as an option. And that tends to make up for a little bit of the compression on the yield.
That's interesting because there is an interplay here.
Yes.
So if you take too much of equity stake, then
Yes.
your focus changes.
Yes.
At the other end, if you just lend to them, then again
Yes.
you are a little exposed.
It's a fine balance. I think our investors are very risk averse. It's mostly insurance companies, a few large families. And their counsel to us was, look, just don't lose too much money. So our bias is that all our debt tends to be senior secured. Our equity is an option. So there's no capital at risk on the equity side, right? So we today, have option positions in these 25 companies that have all appreciated very handsomely. But we have a few lakhs of exposure, in terms of the actual capital that's gone in on the equity side.
So then it doesn't show up really as a dilution
That's
to the
right.
existing holders
That's
till and if and when you exercise.
That's right. And if and when it does happen, we are fairly practical from our view on. If we can double the value of our equity in a 3-year time frame, and within venture, that's not unusual, we will hit our target returns. So if you double your money on the capital gain side and you make your 14-15% yield, you end up actually in a low 20s IRR scenario. And that's a pretty handsome return as far as our investors are concerned.
Coming back to Vikram, what are the expectations on the venture side, and what's a typical investor looking at in terms of expectation of return over what period, and what makes him nervous? And over the period that you've been in this industry, what are the safeguards that help cushion it or in some way assure the investors that this is a good deal? What are the things that you think work?
Yeah, so on the tenure side, I think the challenge that we had for first fund was because this was, these institutional investors did not have experience of investing in venture capital. They only understood 7 + 1 + 1, which was applicable for private equity. They said that's what we understand, so we had to live with that. Therefore, it put pressure in terms of what stage we could actually invest in. We could not do seed stage, pre-Series A. We did actually a combination of Series A, Series B. And actually it worked out quite well for us because, the balance worked out, very well in terms of the returns as well. We already started returning the money to our investors, and hopefully we should give them about 30% IRR at the gross level. And I think, of course, there are one or two, I would say outliers which are still possible. There are a couple of investments that we have in Fund 1 portfolio, for example, which have the potential to return, more than the entire fund. So I think if that happens, then of course the returns become even better. But at the same time, when you're investing in Series B, we are targeting somewhere around 15 to 20% stake in the company. Given the ticket size we are investing. Series A, we're looking at about 30%, 25-30% stake in the company. Of course, we get diluted as more funding happens. So each company we look at maybe 4-year to 5-year time frame. Of course, with Fund 2, things have become a little better because now investors have also started appreciating that, it takes a little longer. So we have now 8 plus 1 plus 1. So we got at least one extra year there. So that gives us a little bit extra cushion in terms of do a little bit of seeds, so which we've done in Fund 2. We've done a few seeds deals which we've actually done very well. In fact, in terms of returns, they've actually started, scaling up very fast. So I think overall, hopefully, as we start returning the money from Fund 2, which should happen now as well, because there's some exits even started building up for Fund 2 as well. I think we should be able to give 30% return in Fund 2 as well.
Excellent. These are all very mouth-watering returns, I must say. Coming to, again, not really specifically pricing, but distribution. One of the challenges that anyone launching an alternative business will have access issues, as opposed to if a mutual fund, there is a very established distribution channel. You can choose where to go and how to price your product depending on what the cost of distribution is. But Prashasta, what is your idea in terms of, from an alternative space, what are the available channels and where is the money?
Yeah. So I think my sense is, a lot of channels that we maybe a year back or even now don't think are available for distribution, for alternative platforms, I think will start opening up for alternatives. For example, banks, a lot of banks, private sector banks, including in, let's say, an HDFC or an Axis or whatever, I think we have, at least in our experience, seen that they are fairly open to distributing alternatives. We wouldn't have thought this a couple of years back, and we would have thought that only, let's say, wealth management firms or entities who solely focused on HNIs will be your target segment for distribution. But what we have realized is that even at a bank level, there are a set of customers which are available and which would kind of look for alternative assets as an opportunity. And I think the good part is that the overlap that you see between, let's say, a wealth management customer and a bank customer is not very, very huge. So if you kind of try, let's say, for example, banking as a channel, I think it's not that you will kind of come up with the same set of investors. I think you will come up and unearth a new set of investors which you wouldn't be, looking to do or get access to earlier. So I think, so that's one. Second, I think, contrary to a thought process, there is a reasonable amount of market for these kind of opportunities in the tier 2 markets as well. I think there could be, a limited number of investors in some of those cities, but I think, you could collect a reasonable amount of AUM, or you can get access to a reasonable number of customers that you wouldn't have thought you would get. So my sense is, I think banks will kind of emerge as big distributors on alternatives over a period of time. Private wealth management firms will continue to do well on the retail side, and apart from that, I think people will continue to tap into institutions.
Thanks very much, all of you. That's as much as I could quiz you, but we're all here to have the opportunity to directly ask any of the panelists any questions you may have. Very happy to take them now.
In near future, are we looking for regulators to open doors for retail investors or fresh HNI investors to get into alternate investments or VCs or private equities? I mean, anyone would have.
I can take that. I think, so when I did my healthcare fund, the ticket size at that time was 25 lakh rupees for the retail investors. I was actually shocked to see that they changed it to 1 crore. Initially, it was very hard because, I kind of, had already planned some strategy to raise money from, retail investors. I think if you actually look a little deeper, what you realize is that what has happened is many times these private bankers will go and sell the product. The lower the ticket size, the lesser the investor pays attention in terms of where the money is being invested. So in the process, when actually things went bad, all the investors started complaining to SEBI. So SEBI started receiving lots of complaints. So I think in that sense, I think this 1 crore ticket size is something which I doubt that they are going to change. So that's the ticket size which they classify as a retail investor ticket size, but it's over a 3-year period, right? So it's on a drawdown basis. I guess I don't see alternate investments, AIF 1-2 categories seeing a different number. I don't know what you guys think.
No, I don't think there's any specific efforts underway to lower that number.
So, but isn't the major chunk of our ecosystem, the retail investors, actually losing or missing the bus for real appreciation of money? Because by the time a company or a portfolio is in their hands in the secondary markets, it's already been squeezed out. So what they have is a sugar cane with no juice after IPO listing. So the major money is made by people who have huge corpuses, and minimum returns in terms of percentages is made by retail capital or retail corpuses that are very small in terms of ticket size. So, I mean, we should...
That's a fair point, but I think at the same time, I think there is an effort to encourage maybe smaller ticket size on the angel investing side. So I think SEBI has introduced angel funds, which is actually encouraging smaller ticket size. So I guess, I don't know what's the actual, bigger solution for some of these problems. But I guess somewhere these things will evolve over time.
I would like to just come into the defense of public markets, that I get to buy the sugar cane when all the juice is taken out. But I can assure you that there is plenty left even after that. So I guess it's what you're really assessing is that people who really want to go very early, they don't have an opportunity. But I think it is likewise to understand that as early as you go, you're almost with the founder, you're almost taking the most risk of any investment. But doesn't mean that people don't have access to returns per se. Returns come at various stages. Each of our ranges of investment maturity actually do yield fairly significant returns over time, and it all boils down to how the business is run. I thought there was a question here. Yes.
You mentioned that the rental yield is about 8% and the net yield comes to about 13%. Can you explain that once again?
So largely 8% is what you get on an annual basis, and there is a 5% escalation on the rent which goes up every year, or 15% every 3 years. So when you dispose of the asset and you do a backward number, you will get part of that. The 8% will come to you annually, and the 5% will be reflected in your capital. So overall return will be 13%.
So the 5% increase, annual increase is on the 8%.
So the rental will go to 8 to 8.5,
yeah.
But your capital value will also go up by 5%.
So there is a capital
appreciation.
growth.
Yeah.
Okay.
Okay. Anybody else? There's someone in the back there, please. Mike.
This is Rahul. I'd like to understand with respect to venture debt, the upside is kind of limited, and but on the vis-a-vis the equity, but on a downside, if the venture is not to do well, I mean, equity of course doesn't get anything, but even debt will find it difficult. You touched upon it. I mean, what makes you think that this has a lower risk profile?
Sure.
If you could just share some thoughts on that.
Yeah. So, there's a few critical elements that help us manage our risk. One is obviously a fair amount of diversification. So we tend to not be sector focused, and so our capital is spread across many, many sectors. I think today we're in probably every sector one can imagine in the venture capital space other than real estate. So one is to spread it in small amounts across many, many companies. Two, stage makes a huge difference. If you look at where venture capital money is lost, a lot of your zero events happen in the first few years of the company. If you make it past the first couple of years and the business model is a bit more mature, then the question is it going to be a 10x or a 2x? It's not a 0 or 1. So I think unlike venture capital fund, where you have to go as the first money in, we are never the first money in. So we have the benefit of timing our capital into a company such that the business model risk is established, and then we're really taking a question of growth or not, right? So that's the second dimension. And the third dimension is the fact that our debt is a very small portion of the cap table. So in mature businesses, debt could be a multiple of the equity. In most of these companies, the debt is a fraction of the equity. So there is, for every dollar of ours, there's $10 of Accel or Sequoia. That's all. And they will work a lot harder to make sure they don't lose their money.
Thanks. And I sadly think that's the end of the time that we have. I'm sure we could have gone on for a lot, but thanks to all of the panelists. Wonderful discussion. Thank you. Thank you very much.